There's certain just foundational stuff that Denver has that a lot of cities in the United States don't have, like the mountains, like the sunshine, like the diversity. So it will continue to do well.
For whatever reason, people are ashamed or embarrassed of losing money in real estate. Yet the same person will have bought a stock that poorly performed, and there's no embarrassment there. But for some reason, you say something similar in real estate, and it's like, ooh, that guy must not be very smart. It's like, that's not the case. I've lost money on real estate, that's okay. And I really do believe that those that jump in now are gonna be really happy they did.
Hey, Colorado, Chris Lopez here, and today's podcast I'm really excited about. I've got some great experts in the commercial real estate space, and we're really gonna do a deep dive into apartment buildings and multifamily. We're going to go through their backgrounds, and then we're going to talk shop. We're going to talk trends, and we're going to talk recent deal activity. But before they are introduced, I got a co-host today, Matt Malloy, who many of you know. He's on the Property Llama team, and Matt's a landlord, broker, now on the Property Llama team, and Matt has worked with these guys. Good afternoon, Matt.
Good afternoon, Chris. Happy to be here.
Yeah, I'm glad to have you here. And last thing I'll say before you introduce them, we got two Matts. So we're calling you Malloy. And then who's the other Matt in the room today?
Yeah, so with us today, we've got Matt Lewallen and Kevin Calame, two owners of NorthPeak Commercial Brokers, the small boutique brokerage here in Denver that does some of the highest volume of any, even competes with some of the big box brokerages in Denver. So Kevin and Matt, thanks for joining us today.
Yeah, happy to be here. Thanks for having us on.
Very much, thanks.
Yeah.
All right, so before we get into it, Kevin, kind of kick it off. Talk about your guys' background, as investors, as brokers, and then we'll kind of lead into how you guys started the brokerage.
Sure. It probably started a little bit backwards than most people. So we were actually, I'll even go farther back. Matt and I have actually been business partners for 30 years?
Gosh, yeah.
Very
long time.
Yeah.
30 years and a lot of different ventures. It actually started when we sold bookstore to door, believe it or not. So, but yeah, in our real estate, I'll try to make this short because it can be a crazy long story. So the kind of short version is, Matt and I were recruiting college students to sell books. We were up in Wyoming at the University of Wyoming, and we just thought, man, it'd be kind of fun to get into real estate. And so I was calling, I call my parents every week, and on Sunday I called my parents. Tell my parents, yeah, I think I want to get into real estate. And my dad said, you should call your sister. She bought this info commercial thing on how to buy real estate with no money down. And I don't even think she opened up the package for that. And so, of course, I called my sister and I said, hey, did you buy something? She's like, yeah, I never even opened it. And I was like, hey, can you just send it over to me? So she sent it over, and it was this box. And when you opened it up, it had these literally VCR tapes, and it was Carlton Sheets.
I was going to say, was it Carlton Sheets or Robert Allen? Those are two no money down guys I remember from the 90s.
Carlton Sheets, no money down. And so Matt and I went through that every day when we were not working, and went through all the videos, all the worksheets. And I'm here to tell you that none of it worked, except we got motivated, and we believed it was going to work.
Yeah, kind of created confidence, maybe that was ill-founded, but we...
And what's crazy is I shouldn't say it didn't work, because we actually did buy our first 3-unit property, no money down. Yeah. We got a friend to put down the down payment. We bought it up in Laramie, Wyoming. We fixed it up ourselves. Probably shouldn't have, but we weren't really qualified, but we did it. We sold it, made $60,000. Then we bought a 6-unit, fixed it up. Then we bought another 6-unit, fixed it up, all in Laramie, Wyoming. And we thought, man, there's something to this. So we decided, one, we can't continue to do this in Laramie because we're out of product.
We bought all the 6 units.
Seriously. So we thought, where should we go? We were both newly married, and so we said to our wives, hey, what about Denver? And of course my wife was pumped because Laramie was wasn't the funnest place to be. So we went down to Denver, and we went to a coffee shop for 6 months trying to figure out what we're going to do.
What year was this?
2003.
Okay.
Yeah.
Yep, 2003. And so then we finally said, hey, I think we can do this. And after about 6 months, we bought our first 19-unit apartment building and gutted it and sold them as condos. And so maybe you can kind of continue.
Yeah, it was 23,
Okay.
but at the time there were certain rules, probably RESPA guidelines in terms of, well, I won't get into the weeds there, but converting it to 19 created an easier exit as condos. So we sold them individually as condos, and part of it was a good market, but part of it was we probably lucked out on execution, and it went really well. We couldn't renovate them quickly enough, so we bought next was
16 unit on Logan.
16 unit,
and then another 19 unit.
Then another 23.
Oh yeah, 23
that
unit.
we converted to the same building.
Yeah.
Like just
Identical.
literally different street. And then just kept going. Eventually it was we were probably doing about 15 million in sales a year and 5 or 6 million in construction. So it grew to be a pretty big operation. 2007, the whole landscape changed. Nobody could buy an unwarrantable condo anymore. So, where we're normally selling 4 condos a week, it's 3. That's a little weird. It's 2. Okay, it's getting a little more weird. It's 0. It's 0. And we're like, okay, this is what's going on. And then Countrywide comes out and says, hey, there's problems. And then probably most people know the rest is history from there. We just had to pivot. There was no longer a market for that. No matter what you did, the end user couldn't purchase the condo. Wow. But we had been in the market buying these buildings. We bought, 15 apartment buildings over that time.
From different brokerage firms.
From different firms. And so we thought, we'd actually already started getting our license just because we thought that'd be a unique attribute that we could have. So it actually turned out really good timing. Transition to brokerage, and as they say, the rest is history. We've been in brokerage now since 2007. Actually, I don't know how much we've done, but
well, we were. There's a longer story to where Matt just ended with. With our company was called Modo. A lot of people have heard of us back in the day, but we, that was very tough, as you can imagine. And it took us under completely. That's probably a whole nother podcast for a different time with maybe some different types of drinks than water.
Unwinding a $15 million company takes a lot longer, and it's a lot more difficult than you might think.
And that's part of the reason we went into brokerage, because it was something we could do on the side while we were unwinding our company. We were the largest condo converter by 5 times. In Denver. Yes. We were, honestly, our egos probably got too big. We were meeting with Hickenlooper. We were doing talks at big, seminars and things like that, because we were just, young and ripping. And so anyways, it was easy. That was an easy transition for us to get into brokerage. But because our backs were up against the wall and banks were coming after us because they wanted their money after our construction, we became the top brokers in multifamily in central Denver, not because we were amazing salesmen, it's because we were in survival mode. Matt had a baby, and we were just, we were doing everything we could to survive. And so did that for until 2020, and then we were really happy with where we were at, with the brokerage firm we were at. We're very good friends with those guys, but we decided that, hey, I think we could do this maybe a little bit different. And so we started NorthPeak January 1st, 2020, not knowing what was right around the corner.
Great timing, 10 weeks later, huh?
Yeah, it was crazy. And but we held steady. We have now grown to 17 brokers. We are when it comes to multifamily, 5 units plus, we do double the transactions than any other brokerage firm.
I didn't know you guys were that high transacting.
And that counts everybody.
No
matter what year it was built, if it's 5 units and up and it has a Denver address, we have done literally double the transactions. And we're very blessed to have the team we have. We have great brokers. In fact, there was 2 young brokers that Matt and I trained that Hunter and Jack, a call out.
Shut up.
That were actually they beat everybody in our whole company last year. So these guys are studs, and we have a lot of those over there.
I was going to ask about them, and
Yeah.
are they still moving?
Still
with
cranking.
volume?
They're one of the like I
Yeah.
said, the top brokers right now.
Good for them. That's
Our
awesome.
whole philosophy in that space is, there's an 80-20 rule, right? And for us, and I know this is easier said than done, but we just really want the 20% that will do 80% of the production. And in our space, there's different methods, but it's pretty common to just hire as many as you can and see who sticks.
Sure.
That can work. And for a lot of firms, it does. For us, it was like, let's just be really selective. Let's train, and then let them loose. And though it's expensive up front, it's a lot of potential risk on our part, it pays off for us.
Yeah. So, during that time, Matt and I kind of got our footing back under us, and we started buying apartment buildings as well. So we are investors, although we only maybe buy 1 deal a year. And so we love industrial, we love retail.
But are you doing
office.
condo conversions anymore, or just
No,
more traditional
no.
multifamily, value add
Yeah.
type?
Too much PTSD from that.
Yeah. Though I honestly believe there's probably a decent market for that with the affordability issue in Colorado and Denver. There's probably a market if somebody wants to go.
Except
do
who's
that.
buying condos right now?
Yeah. I mean, you got to find the stuff that you can afford to convert inexpensively, right?
Yeah,
because that's what people need. Yeah.
Yeah. So, anyways, now we have 17 brokers here in Colorado. We're doing great, even in a down market. I mean, we'd love to do better. We're about a quarter of what we were doing in the good times, but we're still doing well enough that we actually decided to open up another office in Houston.
Oh, congrats!
Thanks. Yeah, we just opened that up, and we have a great crew down there, and we're just taking the same philosophies that we've done here and what's been successful here, and we're bringing it down there. We're not necessarily looking to grow anymore. We had the right person down there, and it's a good market. It's a totally different market than Colorado. So it's kind of nice we can work off each other a little bit.
I was looking at your listings this morning. It's like there's a lot of NorthPeak signs on that Denver map.
Yeah. Oh yeah.
I mean, you guys have quite a bit of active.
I wish those
right
listings
now.
paid, Malloy. We have a lot lot of listings.
But it speaks to the reach you have and what
Yeah.
you guys have built for sure.
Yep.
Yeah.
Thanks.
So-
I appreciate that.
I want to. I'm excited to get into get into the trends and kind of talking deals with you guys. I'm really curious. I did not know you guys were doing the multifamily condo conversions pre GFC. High level. Again, I got into residential real estate investing in 2010, so I kind of caught the bomb of 2008. Right. I was new then, not in multifamily. I got in that quite a few years later. Can you, from a high level, compare the commercial multifamily market now as to how it was after the great financial crisis? Because my opinion is now seems worse, but I'm just looking at data. It's because it seemed like residential got hit harder then and multifamily is now. But you guys were active and living through it. I would love that high level comparison between GFC and now.
Yeah, I think that I would tend to agree. It's more difficult, more challenging now than it was then. And one of the big differences then, which maybe we'll see some now, is there was tremendous pressure on assets at that point. So we've seen a big run up recently. Values did really well, but rents climbed, and so there was really not a lot of pain on investors over the last couple years. In 2007, it was a different story. We had struggles with vacancy. We had a lot of assets that were literally going back to the banks, multifamily assets. We haven't seen as much of that in this downturn, but it could be coming. We're certainly hearing about a lot of notes coming due. Banks have kicked the can down the road with investors, probably hoping that rents will climb or something will improve operations, but we're not seeing a lot of that. So we could see a few more issues there. We are seeing banks make people recapitalize their debt, and most people are doing that. So TBD, but to your point, it has been more challenging this time around than the
I think it's been
previous
more
time.
challenging too, just because it's lasted so long.
Yeah,
It's painful, right? It's like, I think everybody, they start making sayings like, I can't remember what they
Survive till 25.
Yeah.
and then
Yeah.
through 25, and now I haven't heard the moniker for what 26 looks like.
I think hope got lost.
Yeah,
It didn't work out.
yeah, it's like I can't think of anything that rhymes anymore. But it's been challenging just because it's been slow and painful, right? And it's just and we can talk about this later, but I do believe we're at the bottom right now for a lot of reasons. So I think at least that's what I noticed, is that it seems like this has just taken a lot longer to come.
Yeah. And in our world, you don't really know what the market's doing until 6 to 9 months later, when you can look at some real data, because our sales cycle is kind of long. So my opinion is that I think those that buy today will look back 12 months from now, 18 months from now, and go, turned out to be a good time to buy. Didn't really know that. A lot of things in the market weren't indicating that, but I think rents, we've found the floor of rents. Doesn't mean we won't see more renew at those lower rates, but I think we're kind of there. And we've seen the spike in operating expenses. Taxes now have kind of stabilized. Seems like utilities have stabilized. I don't see a big spike in expenses. So in other words, outside of maybe a little decline in rent, I think NOI is steadying.
Yeah.
So those that do buy today can probably count on the NOI for the most part. But they're buying at, honestly, 2017 values, 20% less than we were selling before. So
Yeah.
that's my...
No, I
yeah.
completely agree. I mean,
Yeah.
that's exactly where we're at. I remember back when we first started in 2009. I remember 2007. I remember our very first listing, and I remember it was on Corona, and we had that thing listed at like I think it was like a 6.8 cap or something like that. And I remember talking about that for the longest time. Like, oh man, when I started, cap rates were as high as 6.5 to 7 caps. And I thought there's no way we're ever going back to that. And now when I'm talking to my, to clients that want to sell, I'm like, you better be above a 6. And I've seen a lot of things come out in the 7 caps. So we're back.
Yeah.
We're back to where we were.
Which is frankly probably a healthy market, right? Where
Oh, yeah.
you can make a return,
Yeah.
even given the debt is 6.
The risk is worth the reward.
Right.
I mean, it's fair. It's fair.
Yeah.
It doesn't, I don't like it as a broker,
You're right.
but it's fair.
Yeah.
So is this market harder because I mean, like, I kind of call it the great stall, right? There's just transaction volume is pretty non-existent. Is it hard just because like it's stalled out and banks aren't taking the properties back? Or is that just like one of the variables in there?
I'd say that's one of the variables. I think what it really, this is my best guess. What it really boils down to is when the market was good, there was a lot of quote unquote blue sky. People thought, I can probably push rents, I can improve operations, I can make this asset more valuable. And so I'm willing to pay today's price. People are looking at it now going, I don't know. And it's possible I'll see operating expenses climb a little bit or rents diminish a little bit. I really don't want to buy in that scenario. So there's still plenty of capital that would like to get deployed, but it's cautious. It's overly cautious.
How much, if any, and this is hard to quantify, but the Colorado legislation, the last 3 or 4 years has not been super friendly to landlords and housing providers. How much has the Colorado legislation created headwinds from buyers, institutional buyers, and just investors in general, if any?
It's had an impact, right? But it's like that's just another straw on the camel's back. It's like we are in the perfect storm, right? It's like we had interest rates go from 3% to 6.5%, right? We had 18,000 deliverable units and not that many people coming in to town, right? And so we had oversupply. which caused vacancy, which caused lower rents. And then you have expenses that went skyrocket, right? And you have insurance. There's some buildings we can't even get insurance on, which I've never even heard of such a thing.
Can you talk more about that?
Yeah, we'll dive into that.
Yeah.
And so you have all that going on. Oh, and then there's also some unfriendly landlord rules coming out, right? So it's like, I mean, any one of those could cause a crash. We got all of them.
Yeah, I
Right?
think the biggest thing it did was it shied away a lot of people, of would-be investors, from the Denver market.
Yeah.
I think they thought, you know what, given the political climate and the potential, there are other cities that I can look at that I don't see that as a risk. So why not peel that risk away by going elsewhere?
Have you seen people like shift more to Colorado Springs or more out of state, or a little bit of both?
Haven't seen many of our investors shift to the Springs.
Yeah.
So it's been mostly out of state?
Those that talk about it are just shifting out of Denver proper in some cases, but predominantly out of state.
Okay.
Yeah. And so anyways, that's the good news behind all this is it's doing what it's supposed to do, and it's correcting.
Yeah, there's a
Yes.
correction.
Right?
Sure,
Yeah.
right.
So it's like that's the thing that it's not fun for sellers. I mean, shoot, Matt and I are, we feel like we're very smart. We've bought really well. We had a building where the bank said you're gonna have to pay down the loan $200,000.
Oh, yeah.
And we had to do that. And that wasn't fun, right? And so it's not fun to go through, but I will tell you again, the risk was not worth the reward before. And so we should none of us should be surprised that we're in this position, right? So I'm just hoping that we are now getting to a normal 6 cap environment, right? And people can say, yeah, the equity I'm willing to put in is worth it. And so, of course, I'd like the interest rates to go down maybe a little bit more, but not down to 3. I don't want them down to 3 again.
Yeah.
I think that one thing that the financial collapse of 2007 taught us, and maybe banks, was just how to underwrite debt in a more intelligent way. And so where I see this whole 6 cap going is that I think that at least in the short term, hopefully the long term, people don't financially engineer returns and pay whatever price they can justify. What people were doing in 2001 was, hey, I can get 3.5 interest only debt. I can pay a 4.5 cap or a 4.25 cap, and I can still make it make sense. That was probably, you were engineering that. That wasn't necessarily a sound decision. I'm hopeful that this next time around, we'll learn from those mistakes and go, okay, yes, debt is good, but I still need to pay a market price, not a engineered price. Does that make sense?
Oh yeah, and
Yeah.
not expect 10% rent growth for every
Right,
year.
right, exactly.
Like
Yeah,
some of those
yeah,
pro forma, it's like, that's
Yeah.
that's not feasible.
Yeah.
I want to go back. So I got a lot of questions.
Yep.
Insurance.
Yes.
Because I've been in some deals. I directly own and invest in where I've seen. I agree. Expenses seem to be softening. Right. Knock on wood. And I've seen insurance drop on a few of those properties, like pretty significantly. And you said you have a few buildings that you are uninsurable.
Kind of.
Yeah.
I can speak to that, and I don't know how much I should go into this, but several years ago we saw a gap in the market with insurance, just really in customer service, and so we actually started an insurance brokerage about 4 or 5 years ago.
Oh, really?
Which has nothing to do with NorthPeak.
Yeah, nothing to do with
Okay.
it. They're totally separate, but we just saw that there was service issues there, and we wanted to solve for that.
Yeah.
So somebody else runs it, but we have probably more knowledge about insurance than I would normally have.
Oh, this is great.
So to your point, almost nothing's uninsurable. It's just there's admitted carriers and there's surplus carriers in the market. Admitted carriers are the names you recognize. They're all the State Farms and Travelers, and
Yeah.
they write on, I'll make it simple, A paper. And then there's surplus carriers. They carry all the stuff that admitted carriers don't want to. Almost all the admitted carriers have left the Denver market for either wind, hail, fire, just the disasters that we're seeing. So you're left with a lot of these surplus carriers. And because of that, prices went from $500 a door to very quickly 1,000 a door, just in round numbers. Some properties, you're up in the mountains where you've got potential fire
Yes.
and wind, hail, and these other catastrophes. Those are pretty difficult to insure. Or properties where they've got old electric panels because the admitted carriers left. Surplus carriers are saying that's a carve out, or they're saying, hey, I'm not going to insure you on replacement cost. I'm going to insure you on actual cash value. But the lender says, hold on a minute, I can't accept that.
Yeah.
And so that it's not uninsurable, it's just very complex.
Or
So,
pay a much higher premium.
Right, yeah.
And it used to be, a big thing that we had is when somebody had Zensco panels or Federal Pacific panels, and you're like, oh, but there was always a workaround. It was, you just switch out those panels, and it was fine. And then they said, well, hold on, is there aluminum wiring going to each of the receptacles? And it's like, yeah, but we can pigtail those. Nope, not anymore.
Yeah.
Oh, really?
Got to replace it all with copper.
You got to replace all copper. Well, think about that. Think about a 1960s building where you have 20 units and to rewire the whole building.
What does it even cost? I've done panels. It's going to be outrageous.
We've seen, rewiring units, 10,000 a unit. Yeah.
So you can see that doesn't work.
Yeah.
Right. And so these have been big issues. Now we're starting to, like, I think like any kind of trend, right, or any kind of like cycle, I should say, pretty soon people start, because of course there's insurance companies that say, well, hey, I'll do it.
Yeah.
I'll do it for 1,500 a unit or 2,000 a unit. And it's like, okay. And then pretty soon somebody says, well, I'll do it for 1,400 a unit.
Yeah.
So, we're going to start seeing
It's a pendulum swing. We think the admitted carriers they will come back. And I think they're going to come back once they see that if they were at 500 a unit and the surplus lines are at 1,500 a unit, can they make it make sense at 1,000? I think those days will return and we'll get better coverage and cheaper insurance. And I think we're kind of on the cusp of that.
Yeah.
So you think it might be kind of like on the downside of peak insurance costs?
I hope so.
Okay.
Yeah,
We
we're
have
very
some
close.
Yeah, we have new carriers coming in. We just added one that, they're being pretty aggressive. So, yeah, I'm hopeful for that.
You just need a few to go, oh, there's a market here. Just like a developer, right? All of a sudden, a city looks really good and a bunch of people go build units. So, similar.
Got it.
So
I was just curious, like, how's the conversation going with sellers and buyers around insurance issues and selling? And so I remember working with you guys, like one of the biggest things was just closing that gap, right, between sellers' expectations, buyers' expectations, and there's obviously so many different components.
Yeah.
So many straws on the camel's back, if you will, right?
Yeah.
Is that gap closing at all?
I think so. And one thing I've always maintained with our brokers, and really since I started this business, at some level as brokers, we're a little bit of the mouthpiece to the market or of the market. Because when you think about it, Kevin's calling 30 people a day. I'm calling 30 people a day. We've got 17 brokers calling 30 people a day. So they're hearing from us what's happening. And so I think that we've now been resonating a tune for a couple years, and it's starting to kind of sink in, like, okay, for a while people thought, oh, the Fed's going to lower rates and then they're going to raise rates and they're going to lower them. And eventually they're like, okay, they're not going to lower them again. I concede. I think people are starting to go, okay, yeah, I'm not going to see rents skyrocket. I'm not going to see operating expenses go down. Okay, where do I go from here? And I think we're there.
Yeah, I would agree. Yeah, we had to be very creative over these last 2 years with our deals to kind of get that, talk about that gap that you mentioned, Malloy. It's like we had to figure that out by doing, master lease option to purchase, and we did multiple of those, and owner carries,
loan assumptions, and
loan assumptions, and it's just like we would do whatever we could to help bridge these gaps or these concerns. But I don't know. I'm starting to like, I don't mean just to be. I am a very optimistic person. That is true. But here's an example that just happened a couple hours ago. A couple hours ago, before coming here, I had a tour block on these 2 6-unit buildings that we have listed. So it's basically 12 units right together in Capitol Hill.
Mm-hmm.
If you rewind 6 months ago, if I had a listing, I would hope to get a showing in the 6-month period, right? Almost no matter what I had it listed at. This one, I had 12 people come to that showing.
Really?
12 people. It was so busy. It got me a little excited because I'm like, this is the old times. Now, the caveat there is that there is a seller financing component to it.
Sure.
So that is a little more exciting. But still, we had plenty of seller financing deals and we couldn't get anybody there.
Yeah.
And so I don't know. You ask how the market is. When people ask me how the market is, you're asking me how my market's doing.
Sure.
Now, of course, I have 17 brokers that I can, see how they're doing. But I don't know. I'm seeing a little bit of activity, a little bit of something's coming back alive.
So you're seeing more buyer interest and more seller realistic expectations?
Yeah.
Is that what I'm hearing?
Yeah. And for a while, buyers were they thought it was the blood would flow, right? I'm going to get a great deal.
Right.
And I think buyers are
Yes.
kind of going, okay, it's not that bad. And sellers are now recognizing that they're just not going to get 2021 pricing. There's a new bar.
This is why I agree. You guys are kind of the mouthpiece of the industry. That's why I like talking to producers like you guys. Kind of my take on there is kind of the Warren Buffett quote. You can buy some great assets at a fair price, but it's not going to be like the blood in the waters. Is that?
I'd say that's really accurate.
Okay.
And I really do believe that those that jump in now are going to be really happy they did. I think they're going to find that they've got a sound asset, well located for the right price.
And there's some basic real estate foundational truths. Buy in the right area, right? We all hear that, location. Well, there's some truth to that. Like, I remember when, everybody's starting to buy out in North Aurora. Well, it showed its ugly head, right? And then everybody's like, oh, I'm going to go down to Colorado Springs. And nothing wrong with Colorado Springs, but there's certain just foundational stuff that Denver has that a lot of cities in the United States don't have, like the mountains, like the sunshine, like the diversity. So, it will continue to do well. It will continue to. I mean, we're going to come out of this. We may not see 2021 anytime soon, but we're going to have a steady up and to the right.
Can you guys talk about some recent deals? I'm just kind of curious, like, high level kind of cap rates, locations, how they came together, and just kind of like high level metrics.
Sure.
Are there brokers doing recent deal? No.
When you say recent,
Back in 2022.
Yeah.
well, I mean, I could give you a couple quick examples. It's hard because, again, I just mentioned we had to be so creative, right?
Yeah.
So, and to put in perspective, when times were good, call it 2021, our firm, was doing 4 to 5 transactions a week. Okay. We're now,
That's crazy.
We're now doing about 1 a week. And we have for the last probably 7 or 8 months. So, I say that to say nothing is normal, right? So, I did Matt and I did this deal. It was a 24 unit up in Arvada, and the seller he owned it free and clear, and so he was able to, he kind of wanted to do an owner financing deal, but he didn't want to pay capital gains. So we came up with that, master lease option to purchase, which acts and breathes exactly like an owner carry. And so he was able to sell it at a price that he wanted because he was willing to be creative in that. And that took a little bit of work because, the buyer doesn't really own the building, right?
Yeah. What's the difference between a master lease and a seller carry?
So, yeah, go ahead.
Seller carry, the seller is truly selling the property and taking a note. He's basically the bank. The master lease, the seller retains title, and effectively the buyer becomes a tenant of all 30 units, and then the residents are subtenants. That's the real simple way of looking at it.
Yeah, so the upside for the seller is they don't have to pay capital gains on the down payment, right? So it's not an installment sale.
Because it's a deposit.
Because
like
instead of
security
a down
deposit.
payment, it's called a quote unquote deposit. And so now so that works really well for the seller, or really owner, but
And a key caveat is, much like an owner carry, you need to have no debt, because if there's debt in place, it's going to have a provision that prohibits you from leasing more than 5 units or 5% or 20% to any one entity. So
Is that deposit non-refundable?
it was, yeah.
Yeah. So in this
Got it.
case, it was. So it literally did act and breathe just like, it's actually 2 documents. It's a master lease, and then there's an option to purchase.
Yeah, there's a
And the option to purchase is the option of the tenant only.
Got it.
Right. So, anyways, the downside to a master lease option to purchase is that a 1031 buyer cannot do it because they're not buying.
right.
Right. So, anyways, that's a deal we had to do. We had to get creative. Right. Another deal that we just did is a retail deal up north. I think it's actually up in Thornton, and it was a situation where, like a lot of our deals, they go under contract, they get extended, they get extended, they get extended because things are just going wrong. Things are moving in the market. Buyers aren't sure if they really want to go through with the deal or not, and it just worked this seller down. They finally blew out of it after 9 months of being under contract, and then my client came in and we got it for a 7 cap with upside. They were way under rent by probably 30% under rent, the tenant that was there. And so that was a situation where they took advantage of deal fatigue, right? And so we've seen a lot of that. Sellers want a certain price and then maybe they get it under contract, but we all know that it's probably not making it to a closing table. And then during that time, the seller thought they were going to sell, and so then they just kind of waved the white flag.
Yeah. One of the expectations that we have to, I don't know the right word here, is, but just keep sellers informed of, is that it's not the good old days where when you go under contract, you're probably closing. It's the opposite. In fact, be aware that as much as I'd love to say the first buyer is going to be the one that closes, lately that hasn't been the case. The buyer shows up, but it's just oftentimes you've got to go through 1 or 2. And frankly, it's because things that kill deals today, you never see coming. And so
what?
Well, sometimes it's just, the buyer's personal situation completely changes midstream, right? And so there's really nothing you can do about that. Or the seller just got insurance and it was $850 a unit, and for whatever reason that underwriter's not going to write a new policy, and now it's $1,600 a unit, and all of a sudden, but now right? Now you're repositioning the deal and probably adjusting the price and going back out to market.
And I do think that we're not going to see that as much going forward.
Right.
I talked about all the straws. Well, they were all coming at us at different times, right? And so now I don't think we're going to have as much surprises, right? Now it's going to be like, if there's vacancies, they're probably going to start filling up. If the rents are certain, when the rent, in fact, I just saw a Cornerstone report that just came out, which they manage 7,000 units in Denver, so they're a great resource and they have great statistics. And this last month was one of the first months this last year where the renewal rate went up by $14. Okay, that tells you something. That tells you it's like you're able to push, right? We haven't seen that.
No.
So that little things like that will start happening. I don't think we're going to see a big hockey stick. It's just going to be, but it's going to be not bad news.
Yeah.
Going forward. So I'm hoping that's the case.
That's a good way to put it.
Yeah.
What about that 24 unit you said were the master lease? What cap rate did that trade at?
Gosh, that's a good question. I'm trying to think. It probably would have been close to a 6.
And that was like pretty turnkey type asset, or was
Was,
it?
yeah.
So it wasn't a heavy value add deal.
No.
Okay.
Yeah. I mean, to answer that question maybe more directly, when we're pricing deals right now that are closing, they really need to be 6.25 caps or better on numbers that a buyer would believe are reliable, that are replicable. Not, oh gosh, 9 of these 12 units rent. No way I'm going to get those rents again. If they believe that the NOI is sticky, you'll sell that at a 6.25, maybe a 6.5 cap, depending on location.
So you're talking about like even like realistic cap rates, not the old pro forma,
Not the old pro forma.
optimistic pro formas.
No more 3% vacancies.
Yeah,
you know,
nobody's
on the brochure.
looking at pro forma unless you really have a compelling case as to why.
So okay, so you're seeing cap rates what 6.25 or so? Is that kind of like core Denver? And
You
then
might do a little better than that in core Denver. Maybe you've got a 6 for the right asset.
okay.
Um,
What about North Aurora? Because I remember when those cap rates
All
get
bets are
compressed
off.
and very close to Denver, it's like, well, that risk reward's off there.
I
Yeah.
mean,
But
yeah,
cap
you're-
rates compressed a lot there a couple of years ago.
You're talking about a market that honestly, I hate to say it for those that are listening that own in that area, but we can't sell anything over there.
Oh,
Yeah.
so nothing's
Like
been
nothing.
trading.
I don't care
Nobody-
what price.
yeah.
Like literally, we have deals that we don't even get a call on.
Yeah. Yeah.
Really?
Yeah.
I mean, when's the last deal that traded in North Aurora?
Yeah. There was Montview. But you know what's funny? That one sold at like 1.7, was taken to market at 2.2, something like that. I think it was on Montview,
Okay.
or 17th, one of the two. But
Yeah.
that's one I can point to. And there's plenty that are out there. Right? You know, there are deals out there right now that are being offered at below the debt, and nobody's even looking at them.
No, and North Aurora's tough, right?
Yeah.
Because it already has a bad kind of name, right? And then now it's nationally
Right.
known
Oh yeah.
as a bad
yeah,
place to
it's-
be.
That doesn't
It is
help.
nationally
I didn't
known.
think about that news.
There is lenders that literally they cannot lend there because of some of the crime that has happened in that area. They can't even. They're not allowed to lend
Yeah.
over there. So no, it's tough.
The good news is that will, like any bad news, it'll eventually
Dissipate.
Fade away.
Yeah.
and be a distant memory, and people will start re-engaging there. But that's going to be a tough market for the next 12 to 18 months.
But I think what you were asking is, what about Arvada? What
Yeah.
about
Yeah.
Lakewood?
Yeah.
What about and I think you can probably do about a quarter to a half a base, half of a cap rate higher.
Okay.
Yeah, 25 to 50 basis points different from what we're seeing.
Yep.
Okay.
Yeah.
What about because I mean, kind of going back here, yeah. I mean, I think a lot of people expected the bloodbath, right, of banks forcing properties on there, and it wasn't until probably Q2 last year in 2025 I started hearing brokers say, "Hey, banks are actually starting to like talk about bringing properties to market." I'm kind of curious here what you're hearing from banks, what type of assets banks are bringing to the market. And I even heard some like, hey, they can't even sell for what their debt is. I'm curious
Yeah.
what your guys' opinion is on that.
So far, that's been, again, poor Aurora. It's been specific to that region. That
Okay.
part of Denver is where we're seeing bank-owned properties. Though we do know there's a tremendous amount of debt that was resetting last year that got kicked down the road. Bank and borrower agreed to maybe some small pay down or just time. But I don't know that that's going to continue to get kicked down the road. So we are going to see some core location or just outside of North Aurora that banks are going to put owners on notice of, I'm not going to let this loan continue. You need to find a solution. So we'll see. I think this year there will be some buying opportunities where I don't think owners are going to take it in the shorts on those, but I also don't necessarily see them coming out with all their equity.
Well, you don't think they'll be wiped out completely?
No,
Oh, wow.
I don't think so.
That's
Some
better news
some,
than I expected, yeah.
Some will be, yeah,
I think when you bring in new build, that may be the
yeah,
case.
yeah.
Oh,
New,
sure.
Some a lot of the new build that came out where they can't even lease it up. Those may not get their equity back.
Yeah,
You're
and
talking about like the big Class A stuff.
And not even
or
necessarily
even a
big,
40 unit new construction. It's probably not worth the debt. If it was built in 2021, 2022, those are going to be really tough.
I was going to ask about the difference between Class A, B, and C, new builds, things like that. That makes sense, yeah. I mean, because we're seeing a lot of that. We're talking a lot about that in the residential space, too.
Yeah.
Yeah. Makes sense, yeah.
So where do you guys see, like, we've got a lot of long-time investors listening to this podcast, right? A lot have directly on multifamily. A lot of, investors, LPs or partnerships in there. Like, kind of what assets, what locations do you see? It's like, hey, there's some really good opportunities here going into 2026 and 2027. Like, where do you kind of see the best opportunities on the buy side?
Yeah, I mean, I guess I'll start. I would say if we're talking to buyers, we don't have a crystal ball, right? But you always want to buy at the bottom. I have a lot of indicators saying that we are at the bottom. We are bumping along the bottom.
I would agree.
And so, but just have proper expectations. This is not a buy it. Remember when 2020 had the bottom for like a month? I mean, and it's like, then you bought and we literally had deals that we sold under a year and they doubled their equity.
Yeah.
Like that. If you have that expectation,
That was highly unrealistic.
yeah, and I just do not see that happening again. And not in my career. I'm sure it will happen again to somebody someday. But you got to have the proper expectation coming in. You got to go back to the old school. Why do people buy investment real estate? And you got to be okay with that. You got to say, you know what? Hey, if I can make 7-8% on my money, and I can also depreciate and also count on appreciation, that's great. Then you should buy. If you're expecting home runs, I don't see that happening.
And I think as far as sellers go, one of the big objections we got when the market was roaring is, well, I don't want to sell. I'm just buying into this hot market.
Yeah.
I think now, if you've got an asset that's not performing or for whatever reason doesn't fit in your portfolio, I don't see a reason not to sell. Even if there is a little bit of a loss there, you at least get a buy in a market where you can maybe take advantage of some loss. That's a tax thing. That's each investor's unique there. But more importantly, you can kind of reset and get your feet under you and enjoy the next run.
Yeah, it's funny. I was talking to an investor a couple days ago, and he's owned for a long time, and he's like, his property is probably worth around $150,000 a unit, and he said, well, I'm not selling unless I get $200,000 a unit, because if I take that kind of loss, and it's paper loss to him, he's owned it for 20 years, then I mean, how can I make that back up in the market? And I'm not here to argue with people, but I will tell you that is not a good investment strategy. I agree with Matt. You take what it's worth, you get rid of it, and you go take that equity and you go buy back into it. And
because there's more upside, right?
There's
Right,
more upside.
Yeah.
I always think it's funny because for whatever reason, people are ashamed or embarrassed of losing money in real estate. Yet the same person will have bought a stock that poorly performed, and there's no embarrassment there. Oh yeah, I bought Tesla, it didn't do great. I took a loss, and everybody's like, yeah. But for some reason, you say something similar in real estate, and it's like, ooh, that guy must not be very smart. It's like that's not the case.
Totally.
The market, if you mistime it, it happened.
Yeah.
So you go from there, and you make good decisions moving forward. So yeah,
and a good decision, honestly, maybe just cut your losses and move on.
I've lost money on real estate. That's okay.
Yeah. So as we wrap up here, whenever we have brokers on the podcast, whether people interested in reaching out, working with them, who's kind of like the ideal clients for you? And to take that question further, I don't know if you guys are directly taking on new clients anymore. Maybe your brokers are, but kind of give like a high level overview of people like, hey, I want to buy into some great assets at a fair price right now. What's the type of client, and then who's the right broker in your team, or what's the right process?
Yeah, that's a great question. We try to pride ourselves in putting people with the right people.
Yes.
Right? And so we have people come to us all the time, and we're very happy and grateful for that. And typically when we talk to them, we say, oh, who you should work with is this person. For example, if somebody wanted to work in central Denver, and Greg and Connor and Austin,
all
those
day.
guys,
Mhm.
those
Yeah.
guys are they live and breathe central Denver. Of course, Matt and I do too, but they would be great, right? But if they said, hey, I'm looking for something on the west side, man, you should really talk to Jack and Hunter, or hey, I am looking for somebody that's going to be really aggressive and do X, Y, and Z. Well, maybe one of our junior brokers is, you got to get somebody that's hungry, right? So, and again, I don't know if I have the right answer. Of course, Matt, to answer your question, yes, Matt and I are always open to taking on new people. And I think a lot of our guys at our office are. And so,
I could almost answer that. That's all very accurate. For us, the ideal client is somebody that we can help go make money and grow with, right? Like some of my favorite people to work with are people that they started with a 4-unit and now they've got 50 or whatever that number is.
So attitude and mindsets.
Yeah. I
important.
mean, if they're hungry to go make things happen, I want to go help them, and we'll both make money along the way. So
yeah, I think Matt and I, we calculated up one time that 70% of our clients are repeat clients. And that's because we have a trust for each other, right? And so if I have somebody that, obviously we have to build that trust in the beginning, but man, it's a lot of fun working with somebody I trust. I could tell you multiple stories of situations where literally I remember calling up some of our clients, Chris and Kevin, and I said, hey guys, there's a deal that just came on the market. We don't have time to even look at it. Yeah. But I need you to put an offer.
Yeah, the contract's in your inbox.
And I literally said the contract is in your inbox. You have to trust me on this. And we already had a prior relationship. They signed it. They got the deal. They talk about that deal all the time to us about how much they love that deal that they bought 15 years ago.
Yeah, it was a while ago now.
Right? But it's building that trust. So somebody that wants to have a relationship based I guess business together, then that's the people we're looking for. Right. If I have to continually battle somebody on why I think something's a good deal, I'm probably not the right guy for them.
Yeah.
Awesome. Well, gentlemen, this has been great. I learned a lot. I would like to get you back to see at some point to even get some more market and deal update. You guys are so knowledgeable. We appreciate your time. Matt and Kevin, thank you. Matt Malloy, thanks for helping to tee this up, and great job on co-hosting today.
I appreciate it, Chris. Thanks for joining, guys. It was a blast.
Yeah. Thanks, gentlemen.
Awesome. Well, everyone, enjoy your week, and we will see you next week on the next podcast episode. Bye, everyone.